It's time to talk about fundamentals of call options and moneyness in general. I'm Brian Marks, the president of Notman Marks Financial Training, and this is The Vault. Many candidates tell me, Brian, I'm good to go with options. I just need a little bit of help with the complex positions, spreads, and straddles. That's not usually the case. More often than not, it's because that candidate cut a corner early in the fundamentals of single positions, tried to memorize something or didn't fully understand, and now they're paying for it because more complex positions are much harder. So let's back up to those fundamentals. I'm going to start by talking about this term in the money and out of the money. We're going to buy one ABC July 40, call it 7. So the owner of this option has the right to buy 100 shares of ABC stock for $40 a share between now and July. And the premium, the cost of the option, is $7 per share or $700 total. So let's talk about some examples. Let's say the stock is worth $12 per share. This investor can buy the stock for $40. Would the investor want to buy the stock for $40 if it's only worth $12? Absolutely not. Absolutely not. So this option they would allow to expire. And that means the option is out of the money. Out of the money, or as I'll abbreviate it, OTM, means the option will expire. The investor would lose $7 per share times 100 shares for a total loss of $700. How about if the stock is worth $52 per share? Would the investor want to buy the stock for $40? Absolutely. Would you want to buy a stock for $40 if it's actually worth more than that? You sure would. So the investor would exercise this option. That means the option is in the money, or ITM, as I will abbreviate it, in the money. In the money means the option will be exercised. And what's the investor's profit or loss? It's $12 per share because they pay $40 and it's worth $52 minus the $7 premium. So they profit $5 per share times 100 shares. So the total profit is $500 on the position. One more term, not as important for the test, but what if the market value is exactly 40? That option is said to be at the money, which fundamentally is the same as being out of the money. It's going to expire. So the critical fundamental item to know here is that a call option will be exercised or in the money when the market value is above the strike price. It will be exercised or be in the money when the market value is above the strike price. It will expire or be out of the money when the market value is below the strike price. And the absolute most important thing to know here is that the terms in the money and out of the money have absolutely nothing to do with profit or loss. The single biggest mistake that candidates make on options is they think the term in the money is the same as profitable. That is wrong. Or they might say, well, it's in the money for me. That's wrong. In the money means the option is exercised, period. Sometimes that's good, and sometimes it sucks. That might be bad for you depending on the side of the trade, but it is a fact. It is an absolute fact that when the market value of a stock is greater than the strike price for a call option, that call option is in the money. That is an incontrovertible fact. The call is in the money when the market value is greater than the strike price. Who is that good for? It's good for the owner of the option. That's going to be good for the owner of the option. Right, so if I back up a slide, we established when it was in the money, the owner of the option made money. They want that to happen. Who wants the option to be out of the money? The person on the other side of the trade, the seller, the writer of the option. They want it to be out of the money. They want no action. They want no excitement. I know it's counterintuitive because out of the money, you might say, well, that sounds bad. It's not bad for everybody. Not bad for everybody. This is the kind of thing that is the most important thing to know for options. That a call is in the money when the market value is above the strike price, and it's out of the money when the market value is below the strike price. And to illustrate this point, we have an ABC July 40 call at 7. You'll notice I have covered up the side of the trade we are on because it doesn't matter. It does not matter. So if the market value is 0, Market value is below the strike price, it's out of the money. It's going to expire. Market value is 10, it's out of the money. The market value is below the strike price. It does not matter. If you're the buyer or the seller, it's going to expire. Market value is 30, it's still out of the money. The market value is 40, it's at the money. That's the same as being out of the money. Once it goes above that strike price, it is in the money. Again, it doesn't matter the side of the trade you're on. And you might say, well, Brian, is that bad for me? It could be. Well, don't I have to know what side of the trade I'm on to know if it's in the money or out of the money? No, no, no. You have to know the side of the trade you're on to know if it's good or if it sucks. So let's say I told you, let me open it up on the next slide. Let me take this box away. Let's say I told you that we actually wrote this option. So now I'm uncovering this box and I told you we actually sold this option. Does it change when it's out of the money and when it's in the money? Absolutely not. If the market value is below the strike price, it is a fact that it is out of the money. If the market value is above the strike price, it is an absolute fact in the universe that it is in the money. When you are sitting in the test, you get a question like this, take your hand and cover up the word buy or sell, because that messes people up when they're figuring this out on the exam. Cover up that word and just determine in the money or out of the money. And what does that word make a difference for? Why does that matter? Because the side of the trade you're on determines if it's good or if it sucks. If you write an option and it is out of the money, that is good. You are happy. You're going to keep your premium. If it's in the money, that's bad. You're going to lose. How much? We're going to talk about that on a future video. Again, though, this key term, in the money, out of the money, absolutely, absolutely nothing at all in the universe to do with profit or loss. Nothing to do with profit or loss. Now, if you want to know how to use these terms, in the money and out of the money, that's really, really important to determine things like the maximum gain and the maximum loss on the position. Really, really important. If you want to know more about that, continue on with the vault. And as we finish up here, just to remind you one more time, who wants an option to be in the money or out of the money? The buyer always wants it to be in the money. The owner of the option, by the way, that's true for calls and puts. The seller always wants it to be out of the money. When is a call option in the money? Let's come back one more time. When is a call option in the money? When the market value is above the strike price. When is a put option out of the money? When is a call option out of the money? When the market value is below the strike price.